All right, now it's time for our segment, This Week in Trading History. Well, this segment right in here is something that I quite enjoy. John, you get to be a part of this, and I certainly hope you add some nice insights to it. This week, I wanted to go back and talk about theglobe.com. And well, you know what? Listen, I have a great video clip that I put together because it was one of the famous IPOs. It was November 13th, 1998. The T-Glow IPO'd, and it went from $9 to trading as high as $97 on the opening day. It was a monstrous IPO. The largest one-day rise on an IPO in history, still is actually the record. And well, listen, let's watch the video and then we'll talk about it.
So why were TV cameras beaming their pictures to a curious world? Because these two rule the globe. Theglobe.com, that is. You've heard of internet stocks going for 2 or 3 times their initial offering price? Well, the Globe made stock market history on November 13th when it skyrocketed 900% on its first day of trading.
All right.
Boosting its two founders' personal wealth to about $30 million apiece.
It's going to be a good weekend.
Oh, this is going to be a great weekend.
Weekend, heck. It's been a great life so far for Paterno, age 24, and Kreiselman, 25.
And that makes the young co-founders of theglobe.com very rich men, on paper at least. Our Garrett Glazer paid them a visit at their offices in New York. He joins us now for tonight's Business Centerpiece. Garrett,
Maria,
what a story.
It's amazing. It's really an amazing story. Theglobe.com started 4 years ago in a college dorm room at Cornell University in upstate New York.
Shares opened at $9 and jumped to $97 on its first day of trading. Then, Steph Paterno was worth close to $100 million. Today, his shares are worth under 20 cents apiece, which makes Steph worth
Almost nothing. That's the sad part of it all.
But didn't you? I mean, you sold on the way through. You must
Barely.
have
No. We had one time to sell in the secondary offering, which netted me under $1 million, and I lost a lot of that trying to make more money by investing in other internet companies. Big mistake.
So you're not a millionaire anymore.
No. Well, I mean, not cash-wise. I have very little cash, but I have a nice apartment, and hopefully my T-Glow stock will go back up one day. Otherwise, I gotta get a regular job.
Remember the old days, the mid-90s. Then the streets of Silicon Alley ran with gold.
Go 2744, 2744, at 4, you're out of the bounds.
The internet was a revolutionary force, the economy an unstoppable train, and the boring old business cycle was declared dead.
8 down, 10, that leaves you 12 down. 10, 20 outside.
Through much of the madness, old-school analysts like Larry Wachtel clung to their faith in the fundamentals. When I talked to him 2 years ago, the internet market was at its frothiest, but it smelt like tulips to him.
Everybody's invested, everybody's happy, everybody's making money. Something's wrong here.
Even Larry Wachtel eventually succumbed to what he now agrees was mass hysteria.
It was happening before my eyes. I saw stocks go up 30 and 40 points a day, and I said, why can't I join in the fun? But most of the people said, maybe these young guys are right. I'm old, they're young, maybe they know. So we followed the youth, and that was our calamity.
Well, why were people who, frankly, should have known better prepared to be maniacs?
Well, greed begat greed, and it was just a spiral upward. And at some point, you should have recognized that it was too late, but you deluded yourself. Yes, it was a delusion, yeah.
Investors around the world might have their finger on the buy button ahead of Lyft's big stock market debut tomorrow. The ride-hailing service, and there's a lot of hype here, decided to boost the price target for its initial public offering from $62 to $68 to $70 to $72. That gives the ride-hailing service a $24 billion valuation, the largest ever for a company entering the public markets for the first time. Is this move a telltale sign that the unicorn has gotten A little too frothy, a little too big for its britches, and that you, the investor, should just sit this one out and stay calm and careful. Our next guests experienced this type of hype firsthand, having discovered what was considered Facebook before Facebook. The Globe.com, T-Glow for short, they were students at Cornell University in 1994 when they created what is widely considered to be the first social media site. The Globe.com posted the largest first-day gain of any IPO in history when it debuted in 1998. It pushed that company's valuation to over $1 billion, but then its stock price collapsed during the dot-com bust. In their first interview together since 2001, here to weigh in on what lessons Lyft can learn from veterans of the dot-com bubble, and of course, what investors can learn are the co-founders and co-CEOs, Steph Paterno and Todd Kreiselman. This is a Fox Business exclusive. It's like old home week, guys, because you were one of the first stories I covered when I first got into business news. Todd, welcome to the program. Steph has been on before, but when you see Lyft about to be put out there, what is your gut reaction?
So my gut reaction is to worry, actually. I mean, look, this is a tremendous company that has had many milestones, but coming through those experiences in the late 90s, it's not lost on me that they're losing a ransom of money. And that's a concern. It doesn't mean that it won't ultimately be profitable. I think it will. Mm-hmm. However, it is a lot of money, and very few, if you look back over the companies in those late 90s, some of them, and Amazon being the best example, matured out of that and became a huge success, Facebook too, but many didn't make it.
Yeah. Steph, when you look at the numbers tomorrow, and they're all excited, and they're going to be standing there ready to cheer, and all the traders will be waiting and ready to press the buy button and say, yay, what would you whisper in the founders' ears of Lyft? And by the way, let me just say, I love Lyft. I think it's a great company. But that said, that doesn't necessarily mean it's an investment for our viewers.
Yeah, I mean, look, I actually love Lyft as well. And the fact that they've doubled or tripled their revenues year over years for the last few years and captured nearly half the U.S. market, I think bodes very well for them. But I would still tell the CEO, whisper into his ear, if you will, enjoy the calm before the storm, because once you do go public, it is a bumpy ride, and shareholders like to sometimes, grab onto the steering wheel and tell you how to run your company. And look, this is a long game. I'm not somebody who typically likes to make bets and predictions about the short term. It's a long game, and you should be ready to invest your capital accordingly and ignore all the noise, the screaming that may come from angry shareholders, the media trying to speculate about
Todd's
where the
laughing.
company should go when
he
there's a short-term.
He remembers those times, I'm sure, right, Todd? And what?
That was freaking hilarious. Like, what a story that was. Now, what's interesting about this, John, was that Stefan Paternot there and Todd Kreiselman, I mean, they were quite the party animals. But it's amazing how much the IPO markets have changed, because back then that was a big deal. It was the first social media company to go public, but we were talking about it barely reaching $1 billion market cap. It was like a $880 million market cap, and it obviously the IPO price was $9, jumps to like $97 intraday high, closes like at 60 something, and then just basically goes down from there. But what's amazing how today, when these new IPOs like the SoftBank and all these guys have figured out, they don't mess around with billion-dollar market caps anymore. When they take these unicorns public, they're going right after the jugular in these 10, 20, 30 billion dollar capital raises, right?
Right. So just like a little trip down memory lane, if I can remember 1998, and we were just getting started in the business. And the thing about tech, if you really want to go back and look at it, is that you did have Microsoft, you did have Intel, you did have Cisco, you did have those kind of stocks. But what the internet did is it gave tech like their own medium. Back in the day, Sun Microsystems and Intel they were suppliers to the business world. They were the add-ons to the business world, and they were just getting into the mainstream. And if you missed Microsoft in 1988, if you missed Intel in 1989, 90, and Cisco 92, what this was giving you, and it was the start, it was giving you a new avenue to get into this new era. But what was really interesting and striking, and I remember when they went public, is if I'm not mistaken, I think they only floated around 3.5 million shares.
Right.
It wasn't big. So if you didn't get it at the IPO price, if you weren't involved in the book, you had no choice but to go out and buy. And if you look at the opening print, the very first trade after they went public, I'm thinking it was in the 60s, 65,
It
60.
was
So
like
just think,
I think even 70s actually, somewhere up there, and then it
so
traded as
so
high
I'm
as 90.
just think about that. Just think if you were fortunate enough to be an initial investor at the IPO share price at, I think it was 8, something like
Yeah.
that, and your first trade was a 77,
But do you
a
think they were
number
all
that
locked
started.
in? Do you think there was a lock in on those?
So back then, I'm not sure if corporate governance really had all of those things kind of tied up. I mean,
Yeah,
I
it's really
you know it
evolved
it
so
it
much
it,
from there,
it
right? So much regulation has come from all of the shit that happened in 98, 99, right?
it's changed, and a firm on Wall Street would still sponsor the Globe.com back in 98, whereas right now if you're trying to raise that kind of money, 8 times 3.5, that really doesn't even get on the radar of anybody. They would even put, the fees aren't large enough. The whole backdrop's not large enough for anyone to
Yeah.
sponsor something like that. So
So anyway, what I wanted to leave it with on this, because I want to talk some IPOs with you later on. But what's interesting about this was that they were that Steph Paternotte was labeled the poster boy for the internet craze out there. I mean, there was that point where CNN was filming him on a night on the town after they made all their money, and he was shown in shiny vinyl pants dancing on a table in a Manhattan nightclub with his girlfriend, and which was some hot model at the time, and
yeah, they had it on CNN. CNN did a thing on it.
yeah, and basically he was quoted saying is, "Got the girl, got the money. Now I'm ready to live a disgusting, frivolous life."
And now
It,
he's living a frugal life. So that's
well,
that's the
you know
lesson.
what? It's amazing because like at least when you look at a guy like Adam Newman from WeWork, I mean he got it right. In the end, the whole thing is blowing up, and he got a 1.7 billion dollar payout handshake from SoftBank. I mean he ain't going broke anytime soon, even though, and he's not going to be sticking around to clean up the mess that he created with that company, is he? Like
No,
I bet you Steph is thinking, man, we should have worked out an Adam Newman style deal. Anyway,
yeah. That's two big differences. There's a difference in size and a difference in time, and that's one thing that will go on these new IPOs. They are going public a lot later in their life cycles. So that those are one of the markers that we're going to talk about later about, what to look for if you're going to dip your toes into this style of investing.
well, let's talk about it.
Yeah,
Let's
yeah.
talk about it. So, I mean, you know quite a bit about IPOs. Obviously, you have a little bit of a Canadian spin on all of it, but like with it's crazy, like these unicorns that are going on in the U.S., right? Which is, and all of them are getting hammered. Whether it's Lyft, Pinterest,
Uber.
Uber, all of these are not working. But you have some good stories for some of the ones that are relevant over here. Like what's on your mind?
Well, just what has worked, and there are markers to sort of like determine what you should be at least paying attention to or seeing. And I'm going to go back a year and talk about Canada Goose. Canada Goose was a consumer product. Consumer was strong. Canada Goose had a very strong brand. Canada Goose went public in the U.S. and in Canada. They had a strong backing. I think Bain Capital was there. They had a strong institutional interest. There were people ready to line up to support this into the market, and they had a plan. They had a plan on what to do with the money. These guys at TGL, going public was the plan. That was the plan. They made it when they went public. And you take a look at guys like Bezos and Zuckerberg, they're just guys in their sweatshirts going into their small offices, writing code and making plans. And that's a big, big difference.
Yeah.
But a Canada Goose story, like an IPO, which I believe went up 4 times in the first year. And even if you didn't get it on the IPO price, you could have got it 10%, 15% higher and still been along for the ride. But on these IPOs, really, what's been happening in the U.S. is it's almost an exit strategy now for some of these companies where they've been public for so long. Look at Uber. They were public forever. 20 rounds of financings, all the VC guys, still not making money. When the capital runs out on the private equity side, there's only one thing left to do. You go public or you start going into the debt world. And when you get into the debt world, things can get ugly real fast. So,
it's better to take suckers' money.
It's better to get funded. But talking about suckers, I don't know if you there's been a lot of talk last week about these math geniuses at Renaissance. These guys, I think Simons is the name, and algorithms, PhD, so on and so forth, and how they were able to generate consistently better returns. The one thing that I got out of that was really kind of interesting is that with all those algorithms, it really kind of came down, at least in the article that I read, to one thing is that they kind of almost zeroed in on who they were betting against was the big thing. They weren't really, I don't know, it wasn't like they had some secret sauce in that way, but what they wanted to do is they wanted to be investing against the people that either were, they describe them themselves as bored dentists that were day trading just off spec, or just uninformed novice investors. They found that was the one thing determinant that got them the most success. And I guess just a lesson, like, hey, do your homework, right? Right? Come prepared.
Absolutely.
The dog didn't eat your homework. The market doesn't care. The market doesn't care if your dog ate your homework. You're not getting a pass.
All right. Well, listen, we'll continue this conversation on in the after hours later.